Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today controls a portfolio with his partners of over 3,000 multifamily units. His other company pools funds to allow investors to passively invest in businesses and other income-producing assets. Ike Mutabanna is the founder of Zane Holdings. Ike, welcome to Purchase to Profits. It's great to have you on the show.
Wonderful. Well, thank you for inviting me, Seth. This is awesome.
Yeah, I'm really looking forward to this. So to kick things off, tell us about your real estate goals right now. Where do you want to take it?
Yeah, well, absolutely. So from the perspective of real estate goals, right, I think one of the key things that I've learned in my journey in the real estate industry, which is that a lot of people who have my kind of background, who are not from a background where real estate was a part of our lives, where our families knew about it, our real understanding of real estate stops primarily at perhaps buying a single family house or a condo, putting it on rent, and you think you're going to make some money from that, perhaps when it appreciates, but really beyond that, the level of education is very limited. Mm-hmm. So on the other hand, what is called as traditional investing, right, which is stock markets and mutual funds and ETFs, there's so much noise out there that people just get drawn in, not realizing that while in no way am I minimizing the positive impact of doing that, you're leaving a lot on the table in terms of the risk and value equation by not looking at alternative asset types. Yeah. So really my goal, if that's what you ask, is over the next several years, I want to build out a platform that allows the investors that I've met along the way, as well as those who've been with me for a long time, to learn about a wide variety of commercial investing opportunities. Multifamily is certainly one of the real awesome ways of doing it, but there's so many other ways. I mean, in so many conferences, I come across people doing RV parks, marinas. I recently am investing with a group of people passively in a project which is going to build a studio for the entertainment industry. So there's just so many interesting things going out there that a lot of people with our background don't think we can actually participate in that. We don't even know we can. So I want to bring that forward.
Yeah, I find the same thing in talking with my own investors when we talk about deals. They have no idea what's on the other side of the fence in terms of what's possible in real estate. And I think it's great that you're starting with that education platform. You're looking to educate people on opportunities that they can participate in.
Right. Absolutely. Yeah. And my goal, really, I'm not trying to change anybody's life in terms of go leave your job and do that, or, leave whatever you're doing. There's a lot of that kind of noise out there as well. If it is something you become passionate about, that's great. But even otherwise, just become better stewards of your wealth, better stewards of the hard-earned money, and get the benefits of investing where you can get steady cash flow returns, perhaps participate in some appreciation as well, benefit from the tax advantages of real estate, which is nobody really thinks about.
Yeah.
And in commercial, those tax advantages are far more than in the small family house that you might think about. So yeah, there's a gamut of things that we can help people learn.
Yeah. And so, and you mentioned, people with a certain background may not appreciate the advantages of real estate. How did you get started in real estate? Did somebody talk to you about it, or did you read a book?
Well, I think accidentally fell into it. So I dabbled a little. So I right now I currently live in Dallas, Texas. But until 4 years ago, I used to live in the Boston area. I was in the tech world, primarily in the startup industry, and my circle of contacts were typically people like me. Right? They were either technology people, or they were marketing people, salespeople, people with a specific worldview, a specific view into investing. And the only thing I really got exposed to was the stock market, and to some extent got exposed to the single family rental space as well. But then the 2008 recession happened, and every single person who had invested in single family houses, went through a really, really tough time. Including myself. So cash flow was a far off concept at the point, but even in terms of appreciation, we basically lost money at the end of it. So certainly those who had the capacity to hold on probably have recovered some aspect of that. But the reality is it made me realize that, or it made me feel at that point that real estate is probably not for me. Now, at some point, the company I was working for, the head of sales there, she had started investing passively in real estate through her IRA. She had created a self-directed IRA, started investing, and every time we would be out on sales calls, and I was the chief technology officer of that company, so I would accompany her to help, from a tech perspective. But she would talk a lot about, how her investing is getting her, this passive income. She really has to do nothing, and I'm like, that doesn't sound realistic. I mean, I have done that, and I've seen that you can make, like, you can barely break even. And it just got my curiosity piqued enough that I said, I need to learn about this. So that really was the starting point.
Yeah. And what took you from learning about it to actually taking action and doing it? Because I think that's a problem, or not a problem, but that's something a lot of people struggle with. They like the idea, but they can't take themselves to actually make the jump.
Good point. And I have to say, right, as I said in the beginning as well, that is not for everybody, and nobody should feel that they need to do that. In fact, I was recently in a conference in Denver called the Best Ever Conference, and they actually had a panel where there was a group of people who were passive investors and a group of active investors debating which is better. And it was interesting to see that at the start of that, they had a survey of the audience, and I think 78% said active investing is better, right? By the end, it was almost even. So that goes to show you that there's things about passive investing that can get you good results as well, and you don't need to be active. But that said, when I started, I basically started by passive investing. I followed in the footsteps of my friend, invested passively in a couple of deals, and truly saw the benefit. I truly saw that with a little bit of due diligence and just understanding the deal and making sure that I was investing in something that made sense to me, I was starting to see steady cash flow coming in with very little work, or actually no work, in fact, on my end, because I was a limited partner, passive investor, literally was just, depositing the check every month.
Yeah, that's a lot of hard work depositing the check.
Right.
Yeah.
So I was happy about the fact that I'd made a good investing decision. But at some point, what happens also, I think you might reach a point in your life where you might say to yourself that I want to try something else in my life because I want to build a different foundation for my family, right? A different legacy that I want to set for them. And it occurred to me that though I had passively invested, I hadn't done the work of really studying the space strongly enough to understand if and how I can actually leverage that to make it better. So I started reading some books. I picked up, the first book I picked up was Apartment Investing for Dummies, right? And it's crazy to start with a dummies book, but trust me, it actually was transformative. It was. I wouldn't recommend that book, to be honest, in terms of being able to gain a lot of knowledge, but I think it sparked that interest in my head that there was something here that I had not known enough about. So that led to several other books. I read Multifamily Millions by Dave Lindahl, and then a bunch of other books. And at some point decided to approach Joe Fairless, who was the person that I had passively invested with when I started. And I asked him how I could learn this a little bit more actively. And he said, yeah, look, I'm starting a consulting program. If you want to join that, perhaps this might give you an opportunity to learn and actually do these deals and see if this is something for you, because again, not for everybody, right?
Yeah.
So the investment I had to make to get started was very small at the time. That probably is different for people today because the industry has exploded and there are a lot of venues and a lot of cost that goes into it. So that really, again, is up to each person to decide if the cost is worth the value they get out of it. But for me, the value was there right then. And I went ahead and started actually participating in deals with Joe. And really, that's how I got my start.
Yeah. And I think you made a very smart decision in finding a mentor to guide you along the way and show you they can offer so much experience in terms of, what they've gone through, their best practices, what they're actively doing now. I think that was a very, very smart decision to do that.
Thank you. Thank you.
Yeah.
Absolutely.
So you've been able to participate in a number of deals now. How do you structure your day? Like, do you have any routines or rituals that helps keep you focused on what you want to accomplish?
Sure. I wouldn't say I have a routine necessarily,
Yeah.
but I do have a broad structure that I try to stick to. So the first thing is that I've left my job. I do this full time now, right? I did this on the side for a little bit, quickly realized, and that's again a learning for those who want to think about active, right? That there are people who've successfully done this with a full time job. I just found it extremely tough to do that. So at some point, I did the equation in terms of where do I want to take myself, and how fast do I want to grow, and how far do I want to go? And based on that, I realized that I really needed to get into this full time. So with my wife, made the decision, got into it full time. And as a full time person, there's a specific structure that I try to follow. The first thing is um, the my goal has been, and has evolved a bit. Um, I have become a person who focuses on two aspects. One is ensuring that for each deal that we consider, um, that I understand the market extremely well. The market, the sub-market. I want to be able to be confident that if I had to put my own money, this is a market I want to be in. This is a sub-market I want to be in within that market. And in fact, there are deals you'll find which are in metro cities that are fantastic, have an amazing growth story, and yet we've walked away from those deals because the specific neighborhood, the economics, while may look okay on paper, there's a lot of risk that comes with it that you just don't want to undertake.
Yeah.
So that is a big thing I focus on, which basically means I'm working with trying to establish partnerships with a wider range of people, seeing which market stand of those are good markets to be in, right? The other thing I spend a lot of my time on is investor relationships, because very early on I realized that the adage that people have that if you get a good deal, the money will come, is not necessarily true. You might be lucky and the money will come, but the reality is that people don't invest in a deal, they invest in you. They invest in the trust that they have in you to do well for them, right? Um, I've had investors who've sometimes even asked me saying that, look, I've got some money set aside for my kids' college education. It is spare money, but I was thinking whether to put it in a 529 plan or should I put it in a multifamily deal. Well, that is a big decision, right?
Yeah.
If you're going to convince that person to put it in your multifamily deal, you had better be sure that you're going to be able to do well by that investor, because there's that ethical obligation is paramount.
Mm-hmm.
So a big part of what I do is investor relationships. I basically build up these really solid trusted relationships. Some of them are based on past relationships that I've been able to take to the next level, and some of them are newer relationships that I've built up over time, and created this cycle of referrals where people now trust me enough that they're telling me, Ike, you got to go talk to this friend of mine who's interested in what I'm getting from the investments I've made with you.
Mm-hmm.
So a lot of my time really goes, splits between these two investor relationships, the primary work that I focus on. Market analysis is the other thing. And then my partners really fill in the gaps on the other aspects of the deal.
Yeah. And you mentioned partners and how they become part of the team. How important do you think partners are in tackling these larger projects?
Oh, I think they're critical. I think there are certainly stories out there of people who've done large deals completely by themselves. Joe Fairless, in fact, is a great example. His first deal was completely by himself. But if you see his real trajectory in terms of, he now, I think, controls like $500 million in assets or something like that, something insane. But he didn't get there by trying to keep doing it himself, right? He eventually built up a partnership. And then that has led to other partnerships. So he's got one solid partnership with Frank Resler. They run a particular company. But then in each deal, they bring on other partners who can lend value in other ways. And the fact that someone who as accomplished as him has had to leverage partnerships to get to where he is, I think tells the story. And very much true for me as well. I've built up some key relationships of people who have strong asset management skills, people who have strong understanding of how renovation plans can work, people have understanding of how you could perhaps do value addition outside of renovation. Um, and then people with strong relationships with brokers, property managers, lenders. You cannot expect to really have all of that. I mean, if you are doing that, all power to you. But for most of us mortals, um, there is a better ability to scale and to serve our investors better by building trusted relationships on the partnership side.
Yeah, no, 100%. And out of all the deals you've done so far, is there one that stands out as a keystone deal?
Um, I wouldn't say that. So let's not use the word keystone deal from the deals I've done, because each one necessarily has had its own uniqueness to it.
Yeah.
But I would say that a deal that does stand out in terms of amazing learnings from it, right, has been a deal that I did recently in Houston. And what stood out about this deal is that this was a deal that I was doing for the first time with a new set of partners, right? All the previous deals I'd done with partners that I'd worked with whom I'd passively invested. With this group, I had a relationship, but the relationship had not been where we had worked on a joint venture together, right? It had been more about more of a passive kind of a relationship. So this group, I got to know them, I think about 6 months prior to actually doing the deal with them. They are a solid group of guys who work in the Houston market. They've built up a small little practice of their own. And they followed an interesting trajectory, right? They started with like a really small number of units, built it up to like 20 units, 25 units, 35 units, and they've been trying to scale up. Yeah. Which is a classical path that a lot of people take, and I think it's a great path. What is interesting about these guys is both come from a Wall Street type background. One of them, in fact, was a rocket scientist who moved into Wall Street because he got sick and tired of being a rocket scientist. The other was in the hedge fund, but which was trading in the oil and gas industry. So interesting kind of backgrounds. They brought that expertise into figuring out how they could build up a good, solid multifamily business. What is more unique about these guys is that when they decided that, they said, look, we're going to scale. We have a plan to scale. We're going to grow big at some point. But the one thing we want to do is to build up an ability to really manage expenses solidly, because a lot of people talk about how they can do value addition and add more income. Mm-hmm. But not too many people talk about managing expenses. Yeah. And that is a big focus of theirs. And what they realized after doing a couple of small deals was the best way to build up a practice that controls expenses is to build up their own property management practice along with their deal-making practice. So they started studying and trying to figure out and learning from property managers on how they would manage these properties themselves. And by themselves, it doesn't mean they're sitting on the ground actually doing all the work. But it's also about hiring the right type of property managers, figuring out what's the best way to get the deals in terms of the vendor contracts, how to figure out how to source materials for renovation at the best possible prices. What are those sources? And the overall aspect of squeezing costs by trying to optimize how things are actually implemented on the ground. And that's something as a hands-off asset manager, you only do up to a certain extent, because your goal is to try and find a property management company that is going to handle that for you, and then you're going to supervise that and sort of be on top of making sure they're doing what you believe they need to do. But having direct supervisory control doesn't happen as often, and that's something these guys had really perfected. They had they worked out a way in which they could take expense ratios of 50+% and bring them down to like 35%.
That's huge.
Yeah, so absolutely, right? It's amazing, because you're now creating value in forcing appreciation simply by improving the bottom line without having lifted your finger to do any kind of value add work. So that sort of qualifies as a keystone deal if you think about it, right? This is a 96 unit property that we purchased in Houston. We did a joint venture. These guys, myself and another investor that I know really well, and the way we divided responsibilities was that this other investor and myself, we raised all of the money for that. We signed a joint venture partnership deal where we would basically get about 49% controlling stake in the property from a general partnership side. And this allows us, while it allows them to have the leverage to actually execute things, it allows us to really have a strong kind of a relationship with them, and make sure that we're all aligning our interests. Within the first month, um, we've been able to raise rents without having had to do any renovation work, and just by improving the expense ratio. Um, in some things that we've had to spend a little bit extra money because it was an older property, so we had to replace the roofs. But all of that was taken care of from capital expenditure budget. Didn't really go out of the operating budget. But just a fantastic deal, a fantastic kind of a really relationship we've created. And it's an interesting learning I got out of it, because every single deal I've done before that and even after that has been all around how do we create more income, and which is a very desirable thing, but there's something that people are leaving on the table if they're not looking very closely at expenses.
Yeah, no, I think that's a really good point you brought up. And that operational side is often neglected because people just see, oh, I can renovate. I want to renovate.
Right.
But yeah, no, I'm really glad you brought up that example. So using that example and how you partnered with everybody, how important do you think it is in a partnership to have very succinct and laid out roles for each partner?
I think that is probably the most important thing. Having a partnership where those roles are not clarified upfront. That is the kind of thing I think that leads to project failure. Not failure necessarily from a financial perspective, but failure in terms of the management group not being able to keep it together. A great example right now, I can't reveal the details, but I'm talking to a potential partner. And I'm still honestly not sure. I haven't really analyzed the deal enough to be able to know that I'm going to work with them on it. But the reason the deal came on my table is because two partners put the deal together, didn't have a clarity on roles, and they're under contract. The money is hard, and one partner pulled out because they got into a dispute with them on just how they're actually putting the deal together. So fortunately, this has happened early on. And not after they've closed on the deal, has the option of bringing people like me in to see if we can help, make it happen. But unfortunately, this happens quite often where it happens after the deal. In fact, one of the first deal, in fact, that I did with Joe, that deal was, in fact, we purchased it from a group that had fallen apart. They'd held the property for 3 years and had fallen apart. And the partnership dissolved, and they decided to sell the deal. So that kind of stuff typically happens when a few things happen. One is you've not clarified the roles in advance, so people are stepping over each other's toes, or you've created a situation where you've not aligned yourself based on the roadmap and interest of each partner in what they're out there to achieve. Right? You've got to be aligned on those things. If one partner whose idea is, I'm in this for like 2 years and I want to get out of it and take all that money and go. And the other one's thinking, oh, you know what, we're going to do a buy and hold strategy where we're going to refinance this in 2 years' time and keep holding on to it. Well, by not talking about that, you've put yourself in different paths.
Yeah.
So it's a disservice to you, it's a disservice to your investors as well.
Yeah. So how early on do you start talking about your values and your game plan with a potential partner? Is that something you do right up front?
So if it's a partner that we've worked with in the past, then yes, that conversation starts. There's probably more of a deal by deal conversation in that case, because we already have the trust in that partner to know that we want to partner with them, right? So there's less of a values conversation there. It's more of a deal structuring conversation and a role making conversation. On the other hand, if you've not worked this partner in the past, as in for example, in Houston, where this was a joint venture for the first time, we talked about values and all of that from the very beginning. We talked about the specific deals as well. They didn't have this deal at the table at the time we started talking, but they had other deals. So we evaluated those deals as though we were going to do it together, and understand if and when we were ready to do a deal together, what would it look like?
Yeah.
And so that by the time we got to the deal, we had a fair amount of things. And despite that, I have to say, despite that, we had some kinks that happened in the agreements that we signed as the deal was getting through, and that's okay. I mean, that at least at the time we were, both sides were committed. We knew that we wanted to work with each other. We knew that we trusted each other. We'd seen each other's work. So we knew that, we were all going to do right by the investors. So we were able to overcome that, and we took learnings away for the next time to do that better.
Yeah. And, I think whenever you're entering a new relationship, there's going to be those kinks that come
Right.
up, right? So how do you approach when a kink comes up in a new relationship? How do you approach that?
So I think it depends on the stage of the deal you're in, and what is your comfort level to stay in the deal and use it as a learning versus walking away from it, right? If you're really far into the deal where you're, and these kinks really came up a week before closing. So on both ends, we were a little bit at the point where we had to make it work. We just had to. And these were not kinks in because we disagreed about something. It was because of the way the lawyer had drafted the agreement. So really, we were both blaming the lawyer for it.
Yeah.
But we were stuck where any redrafting of the agreement would have taken too long and we would have lost the closing. So we had to come up with a compromise that worked for both parties, and then made sure that it worked from a lawyer's perspective so that he could turn it around fast enough. On the other hand, if this had happened, let's say, well before we started working on the deal, or even in the early part of the deal, who knows? Perhaps at that point, if we could not make it work, and if the lawyer remained intransigent, we may have walked away from it. I don't know. It's very hard to say, to be honest. But I think the goal is that if you've built a trusted relationship, then you want to try and make it work. So you want to figure out a way in which you can create a win-win for all sides. But if you're still on the fence about it and you're doing it as a first trial run, perhaps it's wiser to walk away.
Yeah. No, that's a really good insight on that. So right now your businesses are growing. You've got lots of stuff going on. How has getting into real estate changed your life so far?
Well, I'll say this. I say the biggest thing in which it has changed my life is the time that I own and I'm able to give my kids. Before I entered the real estate industry, my time was really not my own. I was working crazy hours. I was in the startup industry in Boston. I was, especially as the CTO of the company, I was traveling like crazy. In fact, my younger one was in kindergarten in the last year that I was in that job. And that entire kindergarten year, I probably was able to be part of her school life on a daily basis, maybe like 2 or 3 times in the entire year. I mean, I would sort of get from my wife, I would learn about what's going on, but I never really actively was able to participate. So very soon I realized that it was not, so kids is one aspect of it, but even your personal life, right? You cannot, you start feeling that there's so many things out of your control that it becomes a tough choice situation where you're always trading off things that you want to do, thinking you'll do them after, when you're much older.
Yeah.
And then you don't know if that'll really happen because who knows how long we're going to live.
Yeah.
So I think getting ownership of my time and then being able to use a big chunk of that for my kids has been amazing.
Yeah. And that's what it's all about, right? It's all about the family. Well, if somebody's looking to get in touch with you and learn more about what you're doing, where can they find you?
Yeah, absolutely. So, in the beginning of this conversation, we talked about the platform that I'm working on. It's called the Wealth Chakra. And the idea behind that platform is that take a holistic look at how your building and sort of building a legacy for yourself and your future generations. So we're taking a holistic look. We're talking about a variety of commercial investing opportunities, and the whole idea is to help you learn about these so that you can perhaps go find these opportunities and participate and leverage them and benefit from them. So there are two ways you can reach me. One is by going to wealthchakra.com and signing up in our qualified investor list, which is where you learn about many of these different interesting opportunities. The other is send me an email. My email is Ike, I-K-E, at zaneholdings.com. So that's Z-A-N-E, holdings with an S.com. Ike at zaneholdings.com.
That's great. Well, Ike, I just want to say thanks so much for taking the time today and sharing your success with us.
Well, fantastic. Look, Seth, thank you so much for inviting me to this show, and I hope I was able to provide some value to your audience.
Oh, absolutely. You had some great stories. So thanks once again. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.